Welcome to the Real Estate Investor Podcast. I'm your host, Gary Lipsky of Break of Day Capital. I talk to leading experts to discuss a wide range of subjects to educate investors on best-in-class practices to build legacy wealth and positively impact communities. Let's jump in. Hey everyone, welcome to another episode of the Real Estate Investor Podcast. I'm your host, Gary Lipsky with Break of Day Capital. Hey everyone, we have launched the BODC Multifamily Impact Fund. Invest with a trusted operator with a track record of success. Our fund offers diversification, risk mitigation, tax benefits, and stringent acquisition criteria. If you'd like to learn more, head over to our website at breakofdaycapital.com. Hi listeners, I have some exciting news for you. I'm hosting the virtual Invest Smart Summit on June 6th. We'll cover how to more effectively evaluate sponsors, markets, and deals. We'll have one of the nation's top tax advisors, Tom Wheelwright, speak. And wealth isn't only about money. We'll also have Sahil Bloom, the New York Times bestselling author of The 5 Types of Wealth, and the acclaimed thought leader and life strategist, Tim Storey, join us. This is an event you won't want to miss. Go to investsmartsummit.com right now so that you can live your best life. Today on the podcast, we have Kathy Fettke returning. This was recorded for the Invest Smart Summit that we held on June 6th. This was one of 10 amazing sessions we had covering the economy, best practices for limited partners, tax strategies, longevity, legal expertise, mindset, and other alternative investment strategies. You can buy the recordings and hear from the 18 expert speakers at investsmartsummit.com. It will be your best investment you make this year. Okay, let's get to Kathy Fettke and her incredible insights. Our first speaker is Kathy Fettke. I've known Kathy for a number of years now. We've been on each other's podcasts, spoken at the same conferences, and I always learn a ton when I hear her speak, and I know you will too. She's the #1 best-selling author of Retire Rich with Rentals and Scaling Smart. Kathy is a frequent guest expert on such media as CNN, CNBC, Fox News, NPR, and CBS Market Watch. She hosts the Real Wealth Show and Real Estate News for investors and is the co-host of the Bigger Pockets on the Market podcast. Please welcome our first speaker, Kathy Fettke.
Hey, good morning. Good to see you. Okay, I'm going to share my screen. I've got lots of slides, so I'm going to go real fast today, okay? Let's see. Hopefully you can see this, everyone. I'm Kathy Fettke, co-founder of Real Wealth. We've been helping investors acquire real estate nationwide and syndicating since 2009, helping investors since 2003. And I'm obsessed with the economy because I got knocked out in 2009, and I never, ever want that to happen again to me or you. So let's talk about the U.S. economy and where we are. The Fed target and what they consider, I suppose, a balanced economy is about 2% inflation and about 4.3% unemployment. This is their target, and they have to balance the two. If there's too much inflation, they have to bring it down, but high employment can cause inflation. So it is a constant balancing act for the Fed. And interestingly enough, right now, despite everything you hear and see, the Fed is at its target. Inflation is down very close to that 2% mark, maybe even under at this point. So they're at the bullseye. And unemployment is right about 4.3%. So if you were to freeze frame this economy right now, my sweet husband just brought me water. Thank you, dear. If you were to freeze frame this moment, you'd say we have a perfectly balanced economy. And yet, and here's the breaking news. Just today, this is as new as it gets, unemployment increased by payrolls. Payrolls increased by 139,000 in May, above expectations, holding the unemployment rate steady at 4.2%. So again, like if you just looked at that snapshot, you'd think we're doing great. And yet consumer sentiment, look at this. It's not so good. Consumers expect inflation and rising unemployment, even though we're not there. Now, why is that? Well, I think we know it's that it's been a crazy year, right? There's been a lot of uncertainty, a lot of changes, a lot of conflict. And in the last Fed minutes, when the Fed decided to hold rates steady at the last meeting, the word elevated came up, or uncertainty came up a lot in that report. And of course, it has to do a lot with trade policy and potential inflation because of that. So this is where investors stand. It's like right now, everything's fine, but what could happen? And it's the what could happen that's got everybody kind of freaked out. As a result, there's investors react and business owners react to what they believe could happen, which is if there's tariffs, if it costs more to bring in your products that you need for your business or just, to sell to consumers, if that is going to go up dramatically, then of course businesses are going to buy as much as they can before that happens. So we actually saw in the first quarter of this year that the GDP went down. And normally that would be a prediction of a recession. But in this case, as you can see here, the quote, the decrease in real GDP in the first quarter reflected an increase in imports. Everybody getting their stuff before those prices go up. And that sort of skewed things. So that's going to skew the next quarters too. So that just, again, it's this uncertainty. We're not reading the data the way we normally would, and it's confusing. And of course, investors don't like that uncertainty. And we saw the stock market just all over the place. It dipped and it came back. And you can see it really dipped the stock market when there was the announcement of Liberation Day of all those massive tariffs. And then it got, stalled and changed and so forth. And the stock market went back up when it looked like, okay, maybe these aren't going to be as bad as we thought. And then stocks really climbed after the court blocked some of those tariffs just last week or, about 2 weeks ago. Where we kind of stand now with the tariffs is that generally speaking, not generally, but the Constitution says that when it comes to taxes and tariffs are a tax, that does need congressional approval. Trump was able to get around that using, old trade. It was the Emergency Act or something like that. So that's all being questioned right now. Are we truly in an emergency? There could be workarounds you can see in Section 122, but right now we have sort of this 90-day pause of like what it's still uncertain, but looking more like eventually these tariffs are going to have to get congressional approval. And again, that's part of why the stock market went back up and partly why recession odds have dropped. JP Morgan research reduced the probability of a recession from 60 to 40%. And also say that probably it won't be a robust economy, but not necessarily a recession. And also they expected that the Fed is not going to start easing, not cutting rates until December, and possibly 3 cuts next year. And this is not what a lot of commercial real estate investors wanted to hear. There's been this saying, survive till 25, with this belief that the Fed was going to cut rates because they said they would. Last year, they said, there's going to be like significant rate cuts. And now it just really doesn't look like that's going to happen. So I think now it is like 27 or something. I forget what the saying is now, but it's been really confusing, certainly for commercial real estate investors. So how does this all affect commercial real estate? Well, we know that the 10-year Treasury is up, and the 10-year Treasury very much reflects what's happening in the mortgage world, and also with it's more the Fed fund rate that affects commercial real estate loans. But as far as the Treasury, it's kind of the 10-year Treasury is kind of around 4.5%. It's been bouncing around, and there are some experts who think that that's going to continue to rise due to inflation. So basically, in the past, investors would buy treasuries, they'd buy bonds for safety. If there was fear of a recession, they would buy bonds because it's kind of a sure thing. The U.S. government's, borrowing money and probably going to pay you back. So, but when the economy is looking robust, Or if there's going to be inflation, then you don't want a 4% return if inflation is going to be higher than that. So investors tend to get into stocks and other things if they think there's going to be inflation or a robust economy. But it's all sort of up in the air now, because even when there was a fear of recession, there was also a fear of inflation. And so actually investors weren't buying up bonds for safety. And so even though there was a recession threat and uncertainty where there would normally be the 10-year treasury going down because investors would be flocking to it, that didn't happen this time. And as you can see here, cap rates tend to follow the 10-year treasury. This gap has been closing, but it's something to keep in mind. When we see the treasury going up, then the treasury yield, then that also can mean cap rates would be going up along with it or staying steady. Treasury demand has been receding, and it's not just recently, it's been happening over time. China was one of the biggest holders of US debt. Over the past, 7 years or so, that's really come down. And then just, of course, in the last few months, come down a lot based on trade relations with China. Same with Japan. So right now, the largest holder is actually the UK, which is interesting. And why would that be? Why would be people ditching the 10-year treasury? Well, has a lot to do with our debt. Again, the belief has been that in times of uncertainty, investors worldwide flock to buy U.S. debt because it was a kind of a flight to safety. It was a sure thing. But with this recent downgrade, people are rethinking that. Can the U.S. repay its debt? It's really getting out of hand, as we know. It's been headline news. And, you bring in someone like Elon Musk to try to cut costs and bring down that debt. And boy, there's a lot of pushback, right? People don't want to see anything taken away. It's going to be really tough to turn this around. But you could see the credit rating really had a lot to do with that. So how are we doing again? Like, look at this. I don't know if you've ever gone here, but you should, because you could sit and stare at this all day. The U.S. debt. But look at this, $36 trillion in debt. These numbers, when you go to this page, it'll just keep showing you that it's only going in one direction, and that's up. And the same with the debt to income, because the argument is, well, gosh, just like real estate, if you borrow money to buy an asset and the asset increases in value and you're getting cash flow, debt's not in itself a bad thing. It can create wealth, right? It can help you build, but you've got to see that income. As a result, you can't just have a lot of debt, like credit card debt, just buying stuff and getting no income from it. So the debt to income is a very serious thing, and it has really gone up recently. In other words, we're spending a lot more and getting less for it. So, how does that work? Again, that's why our treasuries aren't as interesting to other countries. And then when you say, well, what are we doing about it? Well, apparently this is what we're doing about it. The deficit is expected to increase with this new big, beautiful bill. The Tax Foundation is saying it could increase the deficit by 2.6 trillion. The Penn-Wharton budget model, even more, and the Congressional Budget Office, even more. And again, the belief is, well, the tariffs are going to bring in more income, and all of these tax cuts are going to bring in more business. And that is true, but that it may not be enough to cover the expense of it. So every president, whether they're Democrat or Republican, has increased this debt. So it's bipartisan. Both sides love to spend money. The thing is, they like to spend it on different things. The left, more entitlements, the right, more tax cuts and military. And of course, we're seeing that now. But none of them are successful in cutting any of it. All right. So here we've got more debt, and at the same time, the Fed trying to reduce the balance sheet because there was so much treasuries bought during the pandemic, during COVID. We know there was massive debt created then, and the Fed, in order to keep interest rates low, they were the buyer of treasuries, and now they've got to sell them off. And so you've got China selling off their treasuries, Japan selling off, and the Fed selling off. That's who's going to buy our treasuries? And if nobody's buying them, again, interest rates, the yield goes up, and that usually is reflected in interest rates as well. So all this happening with rates, basically, I mean, the bottom line of what I just said is everybody's hoping, and collectively we thought as investors, if we just all get together, put our heads together and pray and collectively believe that interest rates are going to come down, they will. And that's not working. It's instead, we're probably going to see rates where they are, if not higher. And that's a really tough thing when so many commercial loans are maturing and needing to be refinanced. And the hope was, oh my goodness, by now rates will be down. The Fed kind of teased us last year saying that was going to be the case, and it's not. But also, a lot of people didn't expect that Trump would win. And so lots of predictions have changed since then. So here we are with all this, look here, big maturing here, loan refinances needed. But it's not going to end anytime soon. The next few years, it's actually 2027 when the most commercial loans are maturing. So we have a couple of years to see if rates come down. I'm not going to worry about those years, but for this year, those loans that are maturing are going to have to refi into probably higher rates, and that's hard. As a result, we're seeing delinquency rates creep up. You've been probably hearing about that. And for the past few years, I think banks also thought that rates would come down, and therefore we're like, hey, we'll extend and pretend we're going to give these troubled borrowers a little more time. It's not their fault. The rates went up so dramatically. Lots and lots of commercial investors are in trouble. And the banks were, kind of extending and allowing, but that's starting to change. We're starting to see them just crack down and say, you got to refi or sell. We need our money back. And so more delinquencies on the rise, but not as bad as during COVID yet, and not as bad as we've seen in the past. So it's bad, but not horrible. And again, it depends on who it's bad for, right? If you're the one getting foreclosed on, it's real bad. But if you're the one looking for the deal, it's good. So again, translation, there's going to be a lot of hurt and pain out there, especially for loans or deals that were really aggressive and easy underwriting. And a lot of what we saw in 2021, 2022, people overpaying for properties. You almost had to. If you wanted to get into any deal, you kind of had to be the top bidder, right? And there was a lot of bids and you had to pay a lot. And then in some cases, you couldn't even get an inspection or anything. It was just sort of like best and final. This is it. You're the winner. You get the property. You don't get to really check on it. And your underwriting's got to be pretty aggressive. So people who bought over the last few years, and I mean specifically 2020 to 2022 when interest rates were low, they're probably the ones who are being the most challenged. Not everyone, but those who are really aggressive. So, but when you look at those numbers, really, it's the office delinquency is the worst. Office, we all know that, especially downtown office, is in big trouble. And a lot of those assets, even though they might be on sale, which is a good thing, right, for the buyer, not so great for the person, the entity or the group that's holding those assets. But anyone who would want to buy at these steep discounts are probably it's going to be a little tough because there's deferred maintenance on a lot of these buildings that are distressed. And of course, in office, we know that there's a lot more work from home still, even though a lot of companies are requiring people to get back to work. They don't really want to pay top dollar for office buildings. Now, in the industrial world, look at that. Delinquency is very low. So if you own industrial real estate, you're probably doing great. And if you're trying to get in it, well, great. You probably won't be able to negotiate as good of a deal as you might in some of these other asset classes, but you can see industrial is doing fine. Retail creeping up, but certainly not as bad as during COVID when everything was shut down. But we are seeing an increase in delinquencies there, and hospitality as well. Again, nowhere near COVID days when everything was shut down, but this could be opportunity. This is why I'm seeing a lot of people kind of jumping into hospitality because there's more defaults and maybe more opportunity. But you're all probably here to learn more about multifamily. And we are seeing multifamily delinquencies rising. I personally know more and more people who are defaulting on their loans, people who probably paid a bit too much and had to be aggressive in their underwriting to even get a deal. Some of those are, going back to the bank, unfortunately. So you can see it is rising, but surprisingly not. It's down a little from where it was. So. And so the question is, well, wow, if there's all these defaults on multifamily, this is a great opportunity to buy. And that could be, but what has to be kept in mind is that even though prices are down, rates are up and lots of costs are up. So you've got insurance costs up and material costs up. So you have to get that discount. It's not even so much that it's a discount. It's like you got to cover the cost. So of course, prices have to go down somewhere. It's going to be on overall price. So if you're in a buyer, you've got to get an especially good deal to compensate for the higher interest rates and higher costs that property might have. But again, there are opportunities out there, and I'm seeing more and more people jump in. So this may have all been a little depressing. So let's get to the positive, good news part of it. Okay, we do expect a lot of things in the big, beautiful bill will probably not pass the Senate, it passed the House, but this probably will. If the bill goes through, and even if it's changed a bit, we may see this bonus depreciation come back. And that is part of what caused the real estate boom before. There were so many people coming into real estate to get those tax benefits. And then on the bonus depreciation, and I'm not going to talk about it, someone probably else will on today's one of the other speakers will probably address this, but what I can tell you is that you're only getting the 40% bonus depreciation right now. And so that's just not as exciting for investors. But if the bill goes through, it'll go back to 100%. And I believe retroactively to January. So that's incredibly exciting. And in addition, it would be for several years. And that tells me that over the long run, there's going to be a lot of money coming back into real estate because of those incredible tax benefits. So again, good news. Another good news is the bill also preserves the 1031 exchange and carried interest. So that's good. And I suppose this is another good news. Like multifamily's already crashed. So if you're sitting here like, oh, is it going to go down more? It doesn't appear to be. Here we are in 2025 and, cap rates have increased, but the forecast appears to be that cap rates would come down, at least according to this chart. We shall see. But part of it is that rental demand is strong. Renter demand held firm in 2024, marking the second highest absorption on record. And the home price to rent ratio is completely out of whack. And that is, of course, the affordability of those who would like to maybe own their own home. Boy, you might just say, why? Maybe it's smarter for me at these interest rates to rent. And therefore, that is good for those who have properties to rent. Another reason, perhaps, that there's a forecast in cap rates coming down is that construction is starting to ease. It's above recent norms, but you can see in 2024, there was a lot of new supply coming on, and that new supply had to be absorbed. And it seems to be getting absorbed, and yet the new supply coming online is coming back down. So overall, vacancy rate is expected to fall, and that's good for those who who own apartments or want to. And here's kind of a tip: is that the opportunity today is more suburban, because we know that the millennial generation is the largest in history, and they fueled a lot of that downtown apartment activity because they were young, they were in their 20s and early 30s, and why wouldn't you want to live downtown where all the action is? But guess what now? They're getting married and they're having babies and they have pets, and they just went through a nasty pandemic. And So a lot of this generation is settling down and wanting to be in the suburbs, wanting more space and for their children and so forth. So suburban aging millennials entering their prime home buying years is fueling this suburban growth. Shift to suburban living accelerates, outpacing downtown in inventory and rent growth. Okay, so I'm going to take us now to the US housing market because commercial real estate is very much affected by rooftops, right? Where people are living. And multifamily is very much affected by that too. If it's easy to own a home, then people are going to choose that generally. If it's harder to own a home, they just can't, and they're going to be renting for a while. So we know that mortgage rates have been up. Like I talked about the 10-year, when the 10-year treasury goes up, generally mortgage rates go up too. And that's what we've seen. They've been bouncing all over the place, but most likely going to stay in the 6%, mid 6% range. Maybe even it keeps kind of flirting with the 7%. And as a result, affordability is at a 40-year low. And I thought this chart was really interesting because you could see here the tale of two worlds, really, or three worlds. You've got people who make over $500,000 who are really just not that affected by any of this. Could they afford a home in 2019? Yep. Can they afford it today? Yep, 100%. Same with you could see here 250,000 fewer people in this income bracket can afford a home today, but not that severe. But when you get to like 100,000 income, look at this, 64% could afford a home. Like half of that can today. And then the same with those who make 75,000, and this is really, the middle class. 48% could afford, now just 20%, less than half. And then of course, when you get into the 50,000, like forget about it. It's really tough. Now, those who make 25,000 or less, well, they couldn't really afford a home back then and they can't today. So this isn't really today's home buyer. It's the middle class who is mostly affected by this. And so therefore, the first-time home buyer age is up a lot to 38. You could see first-time home buyers here at 38. And it used to be, whenever I would give these talks, it would be like 31, 32. That was the average age. Yes, they're raging, but 30, 38. So as a result, with fewer people being able to own a home, inventory is rising, and you're seeing this all over the news. However, the news loves to scare you, and that is my background in the news. That was our job, to get eyeballs and to lead with scary headlines. So don't read the headlines, read the story, and try to interpret it from an investor's perspective. But rising inventory it's like, oh no, another housing crash. Look at all this property on the market. But in reality, we are still below where we've been pre-pandemic. So the interpretation is this is actually a healthy thing. When there was too little inventory on the market with such a large population of millennials, well, then of course we saw prices just go up dramatically, in some areas over 20% per year. That's not sustainable and not healthy for families. So having more inventory is actually a good news story. It's not great if you're a seller and you want to sell your property at top value on day one, like it was happening, but that's not healthy again for anyone to have to get into contract on day one and just, have 100 people on the wait list. So we're getting into a healthier environment in the housing market in terms of inventory. So the way to read those headlines is this is good news. And then because there's more, I guess, well, we had a moment where interest rates came down. And I say this because the housing market is so sensitive to interest rates. So the minute they come down even a little bit, and of course, commercial real estate as well, people jump in. All of a sudden, they have this opportunity to jump in. So in March, rates came down just a little bit, and we saw pending home sales increase. And I put defying gravity on here because in spite of everything I just said, lack of affordability, lack of ability for people to buy, lack of inventory, all of that, we've still year over year seen home prices go up consistently through all of this. So it is just like, why? Why? And, the bottom line is that you've still got this massive group of millennials and very, very low home sales. So there's like 4 million homes that trade hands right now. And you've got, 80 something million millennials. So there's still enough who can afford. And here's the surprising winners of home price growth. New York, I was very shocked about that. Chicago, Cleveland. Cleveland's been a great city at real wealth for investors buying. Boston, Detroit, Seattle, again, like that's been kind of shocking. And then the areas where prices again went up over 20%, well, they're slowing down. So Dallas, Tampa, there is more inventory in those areas. So price growth is slowing down, which is kind of making up for the massive gains of the past few years. So it's not like prices are coming down, but they're not growing as quickly, and they're maybe stabilizing. And again, I just mentioned this, but existing home sales are down substantially to about 4 million, whereas at the peak it was like over 6 million. So you've got like a third of the buyers not there. So home sales are so low that, again, prices can go up because there's just not enough sales happening. All right. And this is interesting because there's been a lot of talk about delinquency rates, and higher debt and so forth. And we are seeing that. You can see here credit card delinquencies are up, student loan debt up. I'm sure a lot of people thought they weren't maybe going to have to pay them, and then everything changed. So delinquency rates up, auto loans up. But look at what is not going up. Mortgages, delinquency rates on mortgages, super low. So why is that? Well, a lot of these people maybe are not necessarily homeowners, people defaulting on their credit cards and their student loans. The people who own homes are paying their mortgage. And foreclosure starts, again, because of that, are at just really, really low. So what does it all mean? Well, again, it's a tale of two worlds. You've got these homeowners, people who already own homes, who are in pretty strong position. Those who got loans had really high FICO scores, really high. These light blue lines are over 760 FICO, as opposed to back in 2004 when I was a mortgage broker, and you had subprime people below 620 scores who did not have a history of paying their bills were getting a very large share of loans. That is not the case today. In fact, the largest share is of people with really good credit, with a history of making their payments. And they are locked in the lowest debt to income. Like the payment compared to their income is so low because the majority of people are locked into these 2.5% to 4% loans. So, we've heard this sort of lock-in effect. 89% of homeowners today have loans under 6%, with the majority in this 2.5% to 4% range. So their payment is so low compared to their incomes, which have risen. And that is, of course, why more people in homes are staying longer. Why would you walk away from that and pay twice your mortgage payment for like half a house? Like they're just not going to do that. They're going to hold on to it. Even if they have to move, they're just going to hold it and rent it. And so we've got a lot of accidental landlords happening, more and more people coming in going, oh, I guess I could just rent this for a lot more than my mortgage payment. And in addition to that, 40% have no mortgage at all. And that's because the other huge generation, baby boomers, the youngest of whom are 60. So you've got people between 60 and 80 who are old, right? So they're older and they've had 30 years to pay off their mortgage, and they're paid off. So they're not in any distress, at least in payment. Maybe in their insurance rates going up and property taxes, but not their payment. And they're swimming in equity. This is from John Burns Real Estate Consulting. Just massive equity gains with these low payments. So again, homeowners are fine. Their equity has gone up. They have sitting on 1 trillion of equity. And the people sitting on the most equity are in these dark areas, California, let's see, Washington State, just you could see here, lots and lots of equity. So let's now look at the other side. I said the tale of two stories. You've got the homeowners, people who own their homes pretty much in great shape. But you have this huge demographic. As I said, 82 million millennials, with the largest group of them at the like 33, 34, which is first time home buying age historically. Now it's 38. So you still have this huge bump of people who probably aren't going to buy a home for a few years and are going to be renting during this time that they figure it out, or at least until rates come down. So as a result, we have this growing population and not enough homes. This was a big miss, a huge miss. This huge section of the millennials that wasn't accounted for in planning. In fact, builders kind of stopped building for the decade before this group hit the market. And there simply hasn't been enough homes for them. According to John Burns, 18 million homes are needed by 2034. And not the homes that are being built. The homes being built today are expensive because costs are up and builders like to make money. They don't like to lose money. So the homes that are being brought on are not generally affordable. And yet 18 million more affordable homes are needed. Additionally, we're seeing household size decrease, and yet single person households increasing. So again, demand for more housing. Then you've got the impact of immigration. I know that's all changing, but there is talk, how much can the Trump administration really do about this? We've all heard the horror stories of ICE and so forth, and immigrants being sent back home. But it's a tiny percentage of the number who have come in. So you still have massive immigration and a need for housing. So from the point of view of investors, what does all this mean? Well, I'm just going to use the stocks and bonds versus real estate theory. So many have said, if I just go into the stock market, I'm going to make more money. Because if you look here and you see the stock price index versus home price index, you see that stocks did really well over the past decade. Real estate did really well too, but not compared to stocks. And we're talking just about stock prices versus home prices. But in this argument, what is always forgotten is the fundamentals, and it cracks me up because it's like, dude, whoever wrote this, you don't understand real estate. Very few of us buy real estate with all cash, right? So in real estate, we have the leverage game. That's the difference. That's the big difference. So let's just use a house. I'm actually a single family investor for the most part, although we syndicate. We've got great syndication coming up. We just closed out a build to rent community of single family, and looking at apartments now, looking at a build apartment, probably going to launch that soon. So I just have probably 95% of my holdings in real estate versus stocks. I'm a big believer, and this is why. I'm going to use just a house. Let's say you bought a $200,000 investment property today. You're probably not paying cash. If you are, good on you, you've got cash, but most people are probably putting 20% down, so $40,000 down on that investment property. Now let's just say that $200,000 property went up 4%. Like I said, has been pretty standard. 4% of 200,000 is 80,000. Wait, no, 8,000. What am I? Oh my God. I should have just used 100,000. let's say it's on a single family. You are probably getting a 25% return just on the appreciation because of the leverage. So then what you haven't even brought into the equation is the other reason that we invest in property. There's cash flow. So then you account for the cash flow and the tax deductions that you get for owning real estate. And it doesn't even compare. This would be up here, way up here, the return on real estate. So again, I think more and more people are realizing this as they hold property and are like, wow, rents are up compared to my payment. There's more accidental landlords. And for me, I can't even compare because I'm not paying for property with cash. You've got the cash flow, the tax benefits, asset protection, values increase over time, generational wealth, and leverage. And adding one more thing on here that some economists disagree with, but to me, I just look at it and go, there's no argument. There is no argument. Back when I was young, when there was money printing happening, it was actually printed, and you would see it on the newspaper, the printing machines, and it would be like, oh my gosh, the government just printed, $30 billion. How dare they? And it was a big deal, and it would make headline news, and it was absolutely unacceptable. And you wouldn't really get voted in if you did that. And then you can see over time, and it really started with the Great Recession, where Bush was like, what do we do? Our economy's falling apart. Oh, I guess we have to create money out of thin air. We need to have the Fed create money and buy treasuries, and who's going to buy our debt if we're failing as a country? Oh, I know, we will. We'll just create money out of thin air, and we'll just buy our own debt. How about that? So that was this sort of financial engineering that was discovered, and it started to creep up, creep up, creep up. Ooh, look what happened in 2020. Like, ooh, okay, well, we're just going to just put everything on pause. No one's allowed to work, but we still need money. So we'll just create it. We'll just have the Fed create money out of thin air and just buy a whole lot of treasuries. And that is why they are now trying to undo that. And that is kind of like we borrowed from the future, and now it's messy. So as a result, the question is, how can the government keep doing this? Well, there's probably only one way, and it's more of the same, more financial engineering, because it's become really clear that nobody wants to go the other route, which is cutting. Nobody wants to cut anything. So in fact, they only want to increase it. So this is probably where we're at for a while. And when you have this sort of financial engineering where you create more money and buy your own debt, it'd be like, I spend too much money. I have so much debt. I'm just gonna get another credit card and just gotta pay all off that debt with this credit card. But then I still got these other credit cards, so I'm gonna also spend those. And anyway, you get it. It goes up and up and up. And so generally, when you're weakening the dollar, when you're creating more dollars, and yet there is a limited number of assets on the table, just like Monopoly. Like you're playing Monopoly and there's a limited number of apartments on the table and houses. And then the bank goes, oh, you know what? I'm going to bring in some more fake money and spread it out to everybody. And now do your bidding. You have more money to do your bidding. So that's kind of why money tends to land in real estate. And even though technically the value isn't going up, it's staying ahead of inflation, because all that money sort of lands in those hard assets. So back in 2005, I learned a lot of this through Kiyosaki, who could see I was a mortgage broker at the time, but I had him on the show, and he's like, that this is all going to fall apart, right? You can't just lend money to anybody and then expect them to pay it back. Like they're not going to be able to pay it back when interest rates go up. There's going to be a bunch of defaults, but you can stay out of the storm. And he explained, get into areas. This is what I learned back then that I use today, and it helps me. It's like a guiding light in times of chaos that has worked every time. And I've been through a lot of chaos since then, and these principles still hold strong. That's why I want to share them with you at times of uncertainty, what people like Kiyosaki do, what I've done, what I've seen others do to get through these storms and still make money when others are losing. Looking for where's the job growth. Even though there's a lot of mess out there, there are areas that are growing. Where are they? And then as a result, there's people who want those jobs and they're moving there. And when people are moving to get jobs, well, they need housing and they need services, and the area grows. And then the city says, oh my goodness, what are we going to do? We got to, no, I think I've got to wrap up here, but we've got to build more freeways and more airports and hospitals and schools to keep up with all this growth. And that creates more jobs. And if you can find all of that in an area that's still affordable, you're going to be okay. Even if the town down the road isn't experiencing that as having a major recession, or the state over here or whatever, if you can find this little niche, then you're going to be okay. And that's what I did. At the time, it was 2005. He said that was Dallas. Dallas was the strongest job growth and population growth in the country, and just massive infrastructure growth. And yet it was affordable. Rich and I flew out, and we could just sort of write up our own loans. I was a loan broker then. I came back with 5 houses like this. This house was $145,000 and it rented for $1,500, and it was in an A-class area, and it just made sense to me. And that's how Real Wealth was born. I came back, talked about it on the Real Wealth show. We bought all these properties, the cash flow, and they're in the path of progress, and they're beautiful and A-class areas. What's not to love? And these have tripled in value at least. So I helped thousands of people do the same. This exists again today. There are parts of Texas that are still growing really quickly. There's parts of the country that are growing really quickly. Part of what's happening right now and the dynamic that's happening is reshoring. It's like, hey, you can either pay tariffs or you can have your business come here. And so far, we've seen some responding to that, like the chip manufacturing. Biden brought that in. It's like, hey, build your chips here. We don't want to go through what we went through in COVID and can't get our chips and the things that we need. So Biden passed the the CHIPS Act. And a lot of chip manufacturing came to the US. We, at that time, started a single family rental fund in Dallas because we knew some of the North Dallas, like Sherman. We knew that billions and billions of dollars was coming in for chip manufacturing. I didn't worry about anything else. It's like, I know these are coming in. I know the houses in Sherman are super cheap. We were buying properties for $50,000 to $100,000 just a couple of years ago because the world was freaked out, and we were like, well, yeah, but there's this opportunity. We just got an appraisal for $10 million on those properties. They've gone up just in a couple of years, 30% because of the timing on that and because we bought right. So you just like right now, also the pharmaceutical industry is same things. Like we don't want to be dependent on other countries based on what happened during COVID. We need some of these things manufactured in the US. So I'm sure you saw the headlines, Roche, a bunch of Swiss companies building their pharmaceuticals here, billions of dollars coming in. A lot of that's going to go to areas like Indianapolis and where there's already pharmaceutical industry and biotech. We've got AI, massive growth with AI. Follow it. Where's it going? Obviously the Silicon Valley, but where else? This is going to be the biggest growth over the next 10 years. Finding out. So there is opportunity. You just have to find it, follow the jobs. I'll go back and repeat because this is the most important. Areas where the jobs are going and therefore population growth, infrastructure growth, affordability. I look for, anytime I hear that there's a freeway expansion or airport expansion, I'm there. Like even when they're just whispering about it, it's like, ooh, this area is growing so quickly. What happens when you're building freeways and airports? Oh my gosh, lots of jobs, lots of jobs, lots of growth. So those things are happening. You just have to find out where. Okay, so if you want to find out more, I do have a Real Wealth Show podcast and real estate news for investors that I do, and my book Retire Rich with Rentals and Scaling Smart. Okay, Gary, I hope I didn't go over time.
All good, all good. Great information as always. You definitely provided some great guidance given the chaotic economic environment right now. And I'm disappointed to hear that my interest rate dance I do every night is not working.
We're all doing it, and just keep going. You never know.
Okay. All right. Well, thank you so much. Remember, everyone, there's a new link for the new session. So thank you so much, Kathy. I'll see you soon.
Okay, thank you.
To all of our listeners, thanks for joining us. And if you like this episode, please head over to iTunes or Stitcher and like, subscribe, and leave a review, as it will help us reach more people. And if you'd like to learn more about what we do at Break of Day Capital, head over to our website at breakofdaycapital.com and sign up for our newsletter and fill out our investor application. We'll talk to you next week.